Welcome everybody to the formation meeting, our first meeting ever of CFOs, accounting and financial professionals. I see a lot of familiar faces, but the intent of this was also to bring in a lot of new people that we have not seen in Highrise in the past and really make this an extension of what we've done for the last 9 years in Highrise. And a little bit of a different value prop though. Highrise is predominantly there for business development reasons. We do use a mastermind approach to get where we want to be. This group is different. This group, we will certainly do business together where needed, but this group is really a true mastermind where we're going to talk about things that are impacting your business, the market, the economy, financial things. The original name of this was Financials Matter, but that was confusing, so we changed it. So really, this is a brain trust group. It's a place where we can share, we can learn from each other, and walk away with something we can implement tomorrow. And that's really the key. It is a safe environment. Ultimately, when we get to our group of 15 or 20, anything that's said here will not go beyond this meeting. So what that does is it also opens us up to the mastermind section, where you will have a chance to bring forward a topic that might be really relevant to your business. It could be receivable management, it could be client stuff, it could be whatever you think is on your mind. And given that we're going to be relatively small in the 15 to 20, everybody should have a chance to voice a question as we go forward. So just to help everybody out, if you don't mind, it looks like Steve has done a great job, and David, Paul, I guess you guys have been trained. Will, if you can put your name, your last name, and your specialty, that would be fantastic. That way we know a little bit better about you. The other thing I will state is as we go forward, this is my fourth one of these focus groups. I'm getting a little bit better. You are welcome to, as you introduce yourself, to put your LinkedIn contact or any contact information in the chat. It is perfectly fine to connect with people, especially if you like an idea and you guys want to expand on it. So feel free to do that. So let's talk about the format of the meeting today. I know I've sent this out a couple of times. We're going to have 2 roundtable discussions today. And then we're going to have a knowledge transfer spotlight at the end of the meeting. Steve's going to champion that for us. And we're going to talk about some of our favorite topics, multi-state tax. It's not always that much fun. We're going to make it interesting. So with that, what we're going to do in our initial roundtable discussion, we're going to combine it into 2. I'm going to have you do a very simple introduction. I'm Scott Levy. I do accounting for middle market companies. So very simple. We had people in our sales and marketing meeting in the last one who decided to say, back when I went to college, and we're like, no, we're okay with that. And I actually had to give them the big T, like, let's not do that. Now you guys are much sharper than that. So we know that you're going to say, hey, here's who I am. Here's what I do very briefly, because we really want to get to the fun stuff, which is the first topic is best practices. What is yours for budgeting and forecasting? So now I pick that. In the future, you guys will get to pick it. I'm going to put it into the chat, and there we go, so we don't forget it. And who would like to kick us off with who you are? Michael, I think you're the guy, honestly. Michael, all right. Here, why don't you kick us off?
All right. Mike Shear with RCX Capital Group. Pleasure to meet everyone today. Who we are. We partner with CPA firms and RA firms to help them help their clients with their tax-advantaged investment decisions, specifically around real estate.
Awesome. And then what best practices do you use for budgeting and forecasting?
As it relates to best practices for budgeting and forecasting, I'm not going to be kind of the prime authority here. I am interested in pulling the group though at some point during this call to see what they're doing in terms of marketing and budgeting for marketing. I think that to me is an interesting topic.
Awesome. Awesome. Thank you. Kat, thank you for posting in the chat. I'd like you to go ahead and introduce yourself briefly and then tell us what you're doing for budgeting and forecasting. Kat, that's you. Go ahead. You're on mute.
Is that me?
No, it's Kat.
Yes.
Yeah, okay. We don't have her attention. Scott Levy, go ahead.
I'm Scott Levy. I am a partner in an accounting advisory firm. We specialize in technical accounting and outsourcing. And so prior, I was in public accounting for all my life. And then you want me to answer the question about the forecasting and stuff?
Yeah.
So, I mean, what we really do with our clients is we do deep dives into understanding seasonality, risks associated with their customers, what are they seeing in collections based on the economy. And we do what we call rolling forecasting for them, which is we'll update it depending on the company. We'll update it either monthly or quarterly, depending on what the company wants, based on new circumstances of what's going on in their industry or in the economy.
Awesome. Thanks, Scott. Paul Lewis, bringing Los Angeles into the house. Welcome.
Hi, everyone. My name is Paul Lewis. I'm an audit principal with Haskell and White. I mainly specialize in real estate, mainly working with clients from different industries within the real estate, either a home builder or a commercial owner. For budgeting and forecasting, I don't think we help the clients much with putting up their budgets other than actually auditing them if it's needed and the forecasting aspect. Again, I don't know if you're asking about our internal side for budgeting and forecasting.
Yeah, either way, just open dialogue, because I think there is challenges in that.
I think from our side on the budgeting aspect and forecasting, we're mainly looking at our resources and availability of resources and the hiring process and the pipeline and trying to combine them both together to come up with our budgeting and forecasting process.
Yeah, it's hard to forecast employment because everybody keeps demanding more money.
It's very interesting in our current market and our industry in particular, I would say.
Yeah, very tough. And then you might not find anybody, so it kills the forecasting.
That's another thing, yes.
So building in some tolerances there are definitely hard to do. Well, thanks, Paul. David Paul, you're next on my list here, CFO advisor.
Sure. CFO advisor, company called Bright Balance, small to middle market clients where we bring in anywhere from CFO to staff level accountant and on a fractional basis. Not an employment substitution like a Robert Half, but more just acting there as with the client, whatever they may need, be it help preparing for an audit, be it a potential sale, need for debt. And as far as your question, Forrest, I think we approach it kind of the same way that Scott had said, is we kind of look at what are those tolerances. We update the forecast for the client either on a monthly or quarterly basis, and really we try to hone into what those drivers are and make our forecast dynamic, where it's real easy to go in and change one input and kind of see what is the cash flow effect of doing that. So I definitely think that's a valuable tool, is to be able to build in those that flexibility into the forecast.
Nice. Yeah, I remember at one point in my career owning a golf company in a recession. I would do a daily cash flow, and fundamentally it was basically a daily budget and cash flow. And it was invaluable when you're rolling through very tough times. So like you said, having that flexibility to manipulate it easily is good, and especially for those CEOs who don't get it, making it easy for them to understand where they are.
Right.
Good input. Steve.
Hey there, I'm Steve Hannibut. I'm with Claris Partners. You'll hear a little bit more about what I do, but right now my firm is exclusively a sales tax provider. We work both in the compliance and the advisory functions. And then as far as budgeting and forecasting, I can say that since the services that we provide are so much more transactional, I can't say that we do an awful lot of that for our clients. But internally, I will say one thing that we've done is we really stay on top of our forecasting. We have a partners meeting every month, and every month we go over the financials. And I know that that's not necessarily a tool, but I think it's a good practice to have. Is we just don't let the numbers get away from us. It's not like we do it biannually or every quarter or anything. It's every single month. And as far as a tool, I will say that we've used HubSpot. And that's I think pretty good tool that we have used in helping our forecasting, and it's really helped us maintain those projects that are in the pipeline.
Nice. So that are you talking about it from a tax perspective? Because HubSpot I always think is a CRM.
CRM. No, absolutely. That's something that we use internally. Correct.
Oh, got it. Awesome. Awesome. Well, thank you. Perfect. Michael. Welcome, Michael Bonino. How do you say your last name?
Bonino, yes.
Bonino. There you go.
You can give it a little more of an Italian, flavor
know.
if you want to. So
I didn't get my pasta today, so.
yeah, that's okay. Yeah, Mike Bonino, CFO for Three-Way Logistics service provider based in the Bay Area. We also have warehouses up in Oregon and down in LA and over in Texas and Georgia as well. So I think on the best practices, there's definitely a lot of room for improvement on our end, but I'd say on the budgeting side, I mean, we have a lot of facilities that are, almost kind of independent in terms of like how they operate. And so it's really just engaging them in the budgeting process, working with them if we've got a bunch of customers or not many customers, and just looking at what's happening in the next 12 months. Trying to make some assumptions on wages and insurance and health benefits and things like that, but really just engaging them in the process and thinking about what's going on with the main customers that we're servicing and where can we grow with those customers or bringing other customers in as well.
Awesome. Thank you, Michael. Yeah, it's tough with that insurance. I mean, how many people are dealing with that these days? It's gone crazy in many, many markets for many reasons. Awesome. Anthony.
Hi, I'm Anthony Chow. I work out of a firm here in San Francisco where we provide tax compliance services and reviews of financial statements. In terms of best practices, we usually try to meet with our clients once every month or once every 2 months to see where the business is trending, what their forecasts are looking like, and we usually do quarterly tax estimates for them to help them budget their cash flow.
Nice. So just high touch points. Nice. Alexi.
Hello, Alexi Toon. I am a managing director with Deloitte Audit and Advisory Practice. So I do both financial statement audits and provide accounting advisory. And I mainly work with technology companies, big public companies all the way down to pre-revenue companies. As far as budgeting and forecasting, I don't do a lot of that myself, but I look at a lot of budgets and forecasts, especially lately, doing a lot of that. I think a best practice we've seen across our clients is, and somebody said this already, but when those forecasts become unwieldy or they're not dynamic in nature and running a different assumption through them becomes an impossible task. So I think a best practice is, and I forget, I think Paul might have said this, but I think the more flexible you can keep them and have the ability to make adjustments quickly is a best practice.
Awesome. Thanks, Alexi, for sure. Well, Will, I don't know if this is a good way to put it, but from the in-house to the outhouse. So Will Peter.
Thanks, Forrest. Will Petter, fractional CFO, industrials businesses up to about 150 million in revenue. As far as budgeting best practices, I guess I'll take it a little bit different direction because a lot's been talked about already. We actually implemented a daily P&L at one of our businesses. And so these guys today could be looking at their P&L for the month to date yesterday. And then we set up a team to review the P&L with the P&L owners, or to review that dashboard with P&L owners weekly. And it was measuring against that budget. So we were constantly reassessing that budget on a very frequent basis. And I mean, the reason we implemented that was because the feedback that we got from the team was we would put together these big budgets, measure comp against the budget. But then on the day-to-day basis, they didn't really have more than the monthly financials to understand what was going on. And so this really got them the tool that enabled us to hold them accountable to that P&L.
All right, Henrik, tax lawyer. There we go. When we get in trouble, our clients get in trouble, we got to give you a call, right?
I'm the opposite of that. I'm the guy who keeps you out of trouble.
Perfect.
Henrik Heckel, transactional tax lawyer, here to save clients money without making headlines or going to jail. So in terms of budget, I'm partner at a firm. We go monthly, we go over the financial performance and compare against budget, which is a useful exercise, as has been mentioned before. I think being on the client service side of it, I try to articulate early in the process what I estimate a transaction will take. And I try to give weekly fee updates to clients so that they are apprised of, we're working on an hourly basis. There can be sticker shock, and that's it.
Yeah, it makes it tough to collect if they don't feel like they understand what they're being charged for consistently.
Yeah.
I remember a time about, I'd say it was 6 years ago, where almost every Highrise meeting, the mastermind topic was receivable management. I'm not sure what was going on 6 years ago, but I remember it was a big, big topic of conversation. So that's a great idea, keeping everybody abreast of what's going on. Ollie, welcome.
Me?
Yep.
Hi, I'm Allie Andrews. I'm a state and local tax lawyer with Jackson Walker in Texas. I don't really have any best practices for budgeting and forecasting because I am the one you call when you're already in trouble. So I don't know how to keep you out of it, but hopefully Henrik can help you with that. Yeah.
Yeah.
Pay your taxes.
Well, for Ollie, it's even more important. You have to actually submit and report, right, Ollie? Because you might not have any taxes, but if you don't report, then it can come back.
I'll assume you do.
It's incredible. It's so much fun. David, long time no see. Glad to have you here.
Good to be here again. Yeah, so I'll just add on budgeting and forecasting. I'm more focused on the internal side, not so much with my clients, because we have a large volume of clients. But kind of the more interesting part for me this last year at my firm has been just figuring out how to turn this firm from servicing smaller clients to providing better services to the wealthier clients, which is my experience, and then kind of showing the owner what the opportunity cost is of not making some of those tough decisions, such as letting go of smaller clients and focusing on the bigger clients and like really pushing for marketing. And so we've had some good growth the last year, but it's like I'm trying to keep us focused on where can we go in the next 5 years, as opposed to just being slammed with work year round, not being able to focus on forecasting for the future. So it kind of shows them like, hey, if you ease the brakes a little bit and focus on the growth piece, you're just going to be so much better off than if you just run it 100% and take every single client that comes to the door.
Love that. Love that. So hard to do it, but sometimes you got to turn away the business, you know, that you don't ultimately.
Vetting clients is probably one of the biggest pieces that a lot of firms just don't do, like really slowing down and seeing if it's a good fit, not just whether it brings additional revenue.
Hmm. And then that backs into the budget, obviously, because now you can say, okay, each client's, I call it AOV, average order value. You guys probably call it something else, but you know, what is that going to look like? How many clients do we need, and how many can we take on given the current staff? Which,
Right.
as we talk about a lot, is the staffing. You know, we get a lot of people in professional services could take on plenty more clients if they just had the manpower, the people power behind it. So awesome. Patrick.
Yeah, thanks, Forrest. Pat Ross, Haskell and White, partner in the audit and business advisory practice here in Southern California. Work closely with Paul since he's about 3 offices down. To that point, Forrest, just on the resources and professional services, we kind of actually do a bottom-up budget, and we kind of go, okay, how many resources people do we have, and what is their output, and can that support the growth? And we've had a focus really on kind of that bottom line metric, not really a top line metric, as David pointed out. And I kind of translated that to some of my clients as well when we talk about budget and forecasting. Do they have enough resources, and are the salespeople aligned with production, and just what that as a holistic organization, are they all aligned to achieve that budget based on everybody's input? And it's not just the ownership group going, we're doing 15% growth and that's it, and then everybody's you throw that over the fence and everybody else tries to figure it out. It's probably not going to work.
Yeah, no doubt. So what do you do when you have, I mean, Will is in this situation in private equity where you have an investor group that's expecting that 15% return, and yet for a fact that doing your budgeting, it's not going to be. There's got to be a happy medium there, right? How do you manage that?
Well, it's really just communications. You can't, that's really, what are you going to do with that budget, instead of, wait until the end of the year and go, well, we didn't make it, so, having some of those other people brought up some of that dynamics and be able to, drill down to what's actually driving it, and can we tweak that along the way if things aren't going to plan.
For sure. Thanks, Patrick. William Haddad at Markham. Welcome.
Yes, hi everyone. Pleased to meet you. William Haddad. I'm a director here at Markham in the Costa Mesa office, and I'm on the audit side. And when it comes to budgeting and forecasting, I think like many of the people here, I don't really put them together, but I do audit them. And, that's one of the most challenging areas, I would say, to audit, because there is a lot of assumptions involved. And, my advice would be, or my recommendation for any company is be reasonable, because, some companies just come up with numbers that they cannot support or back up. And it just makes it hard for the reader or the user of these numbers to rely on. So again, it's just one of the most challenging areas that I would say when it comes to auditing. But yeah, I don't have any other advice on that. It's just
Wow. Yeah, exactly. And you're kind of seeing it at the end. They've already put it out there, and now you're having to say, well, it's not correct. So that's a challenge.
Yeah, I mean, I don't know if it's correct or not, because it involves a lot of assumptions again, and it's all based on future events sometimes that we don't even know if it's going to happen or not.
Yeah, very tough. Thanks, William. Lena.
Yes, hi everyone. Well, we don't do any budgeting or forecasting for our clients. We let it do to all CFOs that on the call here. I think having a good CFO, it's very essential to any company. We're a tax firm. We provide a tax projection. We do tax planning, transaction consulting, and on the internal side, because most of our expenses are fixed, it's mainly salaries, it's subscriptions to law databases or tax software. So we really concentrate on revenue and client management.
Nice. Awesome. Thanks, Lena. Welcome. It's been a while as well. Now, Deepak, I mean, I see Deepak every 3 days. So speaking of a good CFO, Deepak, go ahead.
Deepak Bhakta, B2B CFO. We focus on privately held companies up to 5 million to 100 million strategic level CFO work. In terms of budgeting, forecasting, I would say, aside from other people, to add to other people's comments, I spend a lot of time on the assumptions, and because the assumptions are really going to drive the rest of it. The rest of it is math after that. Obviously, yes, and I agree, keep the model flexible, but small changes in the assumptions could have a dramatic effect on the projected outcome. And whether you asked, somebody mentioned, is it correct or not? Well, by definition, it's going to be wrong, right? What actually happens is going to be something else. Another thing I'd mention is, you rely on, to a large extent, on people in the business. Maybe the CEO, maybe functional department heads or business unit leaders. Rely on them for input on the assumptions, and so generally try to challenge those assumptions, because you want to try to give them some rigor. As I think somebody mentioned, they should be realistic and reasonable, right? So the sanity check has to be there. And what I've also, from prior experience, when these functional departments are asking for capital, and they say, "Oh, I'm going to, pay for this with increased sales or a higher profit," we're like, "Okay, show me your calculation, and then let's build that into your forecast." Right? You're telling me you're going to make more money, then your forecast better include that. Otherwise, you don't get the capital, right? So, and partly unsurprisingly, they like to push back on that. We're like, what makes you think? If it's your own money, are you going to spend that on buying this new shiny piece of equipment unless you're going to get, some more business out of it? So anyway, that's my 2 cents.
Love it. Thanks, Deepak. Alberto.
Hi, I'm a partner with Deepak also. Hi, Deepak.
Oh, nice.
Sorry, I'm late. I was on a phone. I was actually interviewing somebody for one of my clients, on behalf of one of my clients, and boy, she was a chatty soul. I was trying to get her off the. Sorry about that.
No problem.
So I have no idea what y'all are talking about.
Yeah,
but
so Alberto, we are, if you want to just actually just introduce yourself. So is there anything that you are doing with your clients on budgeting and forecasting? Do you have any best practices you wanted to share?
Well, something that came up yesterday. This is about a $14 million company. We handle $5 million to $100 million revenue companies, as Deepak said, and the two owners, they're both 50%, and they literally, one side handles the sales. He could sell ice to an Eskimo, and the other side handles all the administrative. But they have no idea they don't know where their cash is going.
Hmm.
So it's things as simple as I told them, I said, you guys hang on to your mail and open it once a week in front of each other. I bet you would cut expenses by 20% over a 6-month period.
Hmm.
And that's like, I come from the old automotive dealer industry where we knew where a tenth of a percent was. And that was standard business practice. We all went through all the bills, and it's amazing how much information you find doing that. So,
interesting.
That was just a little tidbit that came up yesterday, and I told them if they just did that one little thing, they would cut operating expenses by at least 10 to 15%.
Wow, interesting.
Over a 6-month period, So
I completely agree. I just had an internal audit in my household because my wife is an accountant, and she said, "Let's go through your credit card statements." Businesses. And I'm not sure. I think I got 20. I got 20. Certainly hit about 20 times.
That's dangerous. That's dangerous.
Yeah. Well, that's everybody. That's everybody. So
yeah, I mean, what is this this AI platform you're paying for? It's like, I don't know. I signed up one day. Well, it's reoccurring, and $10 a month. Well, we're talking about small stuff, but when you look at a business, and they're paying for software they're not using to the tune of thousands of dollars a month, it could really impact it. So thank you for that, Alberta. I appreciate it. I've got a few.
I told them, I said, you want to stop any potential fraud, do that one little thing too. So
yeah, I've got a few folks. Nicole, you're off camera, but I think you're here. So did you want to tell us who you are and then chime in on the topic?
Hello.
Hello.
I am here. I am a legal administrative assistant. I am working for Sign and Sealed Legals. I'm on here along with my boss, Kathy Wilson. So what we do is we provide legal services with the high touch approach. We have a various range of clientele, from individuals to law firms, to solo practitioners. So we serve a broad range of people. As for the budgeting aspect, I feel Ms. Wilson would be more knowledgeable on that.
Awesome. Well, thanks, Nicole. Thanks for being here. Kathy.
Thank you.
Yeah, go ahead, Kathy. Are you?
Yep. I guess that's me now.
It is you.
All right. Well, as Nicole so aptly introduced us, yes, that's what we provide in the tri-state area. We provide legal services in the tri-state area. In regard to budgeting and forecasting, we're here for education. We're extended our services to include tax preparation services. And so we're here to get some education and some golden nuggets in order to support that better.
So for people who don't know tri-state, that's Illinois, Indiana, Kentucky. Is that right, Kathy?
Nope, that's New York, New Jersey, and Connecticut.
Okay. Well, I asked AI, and that's what it told me. So I guess AI is all wrong. We got to cancel all of our subscriptions, period. So great. Well, great to have you, Kathy. And yes, this is a part of what we're doing here, is learning from each other and being able to come back to our offices with something that maybe we didn't know from before. Bronson, you're also here off camera, but if you'd like to add in, go ahead. Oh, there he is.
Yeah. Hey, everyone. Sorry about the non-video. I've been rushing to get an analysis done for my 3 o'clock meeting coming up. And I'm a bit behind. So I have been listening. So Bronson Kwan, I am a partner at Keystone Advanced Solutions. We do outsourced accounting from fractional CFO all the way down to junior level bookkeeping, special projects and consulting. So anything that an outsourced accounting department would do, we do. So with respect to your question on budgeting and forecasting, for me personally, what I would prepare for a client really depends, number one, on the client and what their, no pun intended, what their budget is. So that's going to really drive how much work we do and how detailed of a budget we would prepare. But I guess just to kind of go in a different direction than what everybody else is saying, because I agree with everybody else here. A couple clients of mine are looking at exit plans in the next 2, 3, 4 years. And so we need to put together a plan that helps them scale to reach a certain revenue value and therefore a certain EBITDA value, which we can then apply to certain multiples to reach their the enterprise value that they want to sell for. So we look at it from the perspective of where do we want to be at the end of year 1, 2, 3, and 4 from a high level perspective, and then start breaking year 1 down into the different pieces of it. If I know I need to be at X amount of revenue, well, how many orders is that going to take at a certain average quote unquote AOV? You guys were talking about that earlier. What does that AOV need to be? And ultimately, how many customers do we need to bring on in order to achieve that? So we kind of take a backwards approach and then work from there and then determine with the process owners if it makes sense, right? If those numbers are too sort of far-fetched and we can't hit those numbers and they're not reasonable targets for us, right? So there's a little bit of back and forth on that, but we want to know where we're going first before we start putting together the actual budget. And to echo what I think is it Deepak? I think to echo what he said, one thing I learned from a prior CEO that I used to work for is the only thing right about a budget is that it's always wrong. So anyways, that's it.
Nice, thank you. Good luck in that, getting that plan together. I appreciate that. Well, awesome. Okay, so that is our first topic of the day. What we will be doing in the future is I will not be creating these topics. You guys will be creating them and giving me feedback. And then I'll present it and moderate it. So my next topic was how do you identify and mitigate? We don't want to migrate liability anywhere, do we? Financial risk. So that's the topic I came up with, but many of you that know me, I have no problem if you guys have another topic you want to throw out. Otherwise, we'll flow with this. So we've got a half hour. We've got 28 minutes to be exact. So do we want to flow with the how do you identify and mitigate financial risk? Or does somebody have another more clever topic? All right, let's do it.
That's a good topic.
Okay, cool. I wasn't sure. You know, you sometimes you throw a party and you bring white wine and you're worried that everybody's gonna want red wine. So that's how I felt at that moment. So hopefully we're okay. All right.
Financial risk could branch out into 100 tentacles, right?
Yeah, exactly.
Well, I'm curious. I've lost track of who spoke last. Bronson.
Oh, Bronson, yeah.
How people are tackling succession and exit planning. Is that a hot issue? What issues are you encountering as you go through the process? All of that. I'll throw that out as an alternative. Obviously, the group can decide, but.
Sure. I'll tell you what, here's what we'll do is you can take on either. How about that? We'll have an alternative. If you want to go with the identifying the financial risk or struggles that you're having or solutions that you're having in working with your clients on exit planning. So who wants to chime in first? Go for
in
it.
my life, since I threw out the option,
Sure.
It depends on the client. Like exit planning is highly variable, depending on whether you have a client that has an advisor that's an investment banker to bring them to market, et cetera, to help navigate the process. Where you don't, in cases where you do have that and you don't have that, you can encounter, but particularly where you don't have that, you can counter a lot of headwind, both in terms of the client. This is an issue that Steve probably encounters from time to time, but they don't file sales tax returns. They don't file state income tax returns. They file their federal income tax return, but they don't, there are issues with it. And their financials, I had one large transaction where the financials were a hot mess, and it took everything like a year and a half to close, which should have been a 3 to 5 month process. And so there's a lot of struggle in that. And then the additional component that I think gets lost as you're entering the exit planning is taxes are always a huge issue for people, because they see the top line number and they expect that that's what they're going to get, but it more often than not isn't. Although depending on how you deal with the exit planning, you can materially reduce that number. And you could potentially pull out, eliminate it. So.
Perfect.
I want to add to that too. It's like how planning stage to it is, because I kind of have an extreme example of a client who their business was very hard to market, but a buyer happened to come around. They just went to the deal very quickly. We're talking in like, I think 2 weeks, 2 to 3 weeks, and everything was signed and done without even reaching out to us first. And so, yeah, exactly. So, end story was that they ended up paying more in tax that first year than actually received. And so it was just a terrible situation. And if they had had planning like 5 years beforehand, they could have prepped their business for sale and everything. But if they don't use their advisors and reach out, then there's nothing you can do for them at that point. So kind of like, that's an extreme example, but it's so important when you see clients that are getting to that retirement age, like really bring up those points. And it's a tough conversation, but it's necessary.
Thanks, David. Incredible. Incredible. Okay, so who would like to, Scott, Scott Levy, you're up on my top left.
I'll just add from a exit strategy to make sure that your books and records are really where they need to be for due diligence, assuming it's that size of a company, because we deal a lot with that, and we see our clients are looking to buy companies, and companies they buy, the books aren't in order. They don't necessarily follow US GAAP. Projections are unrealistic, all this type of stuff. So if you're going to exit, at least have everything in order so that people looking at you will feel confident in what you are giving them.
Problem is if there's a CPA who doesn't know what they're doing at the top level of upper management, you end up with a nightmare.
I mean, I did, like, for example, I literally had one where the target, they gave us numbers galore, and I was like, gee, they know what they're doing. Every number was wrong.
Wow. Incredible. All right, who wants to chime in?
Henrik, I appreciate you teeing that up for me. I'm just going to expand upon that just slightly. Is, one thing that we try and do is on sales tax exposure, we try and look at least once a year, if not more often. We look at we do a quick nexus analysis for our clients to make sure if they're filing in 20 states right now, should they be filing in 25? Should they be filing in 30? There are plenty of ways to stay on top of that. I like telling the story about one time when I was dealing with a taxpayer, and he was getting all frustrated, and he had his head in his hands. He said, "Steve, I'll tell you what, the worst thing in the world is paying sales tax." And I thought about it for a minute, and I corrected him, and I said, "No, the worst thing in the world isn't paying sales tax. The worst thing in the world is paying someone else's sales tax." And that's exactly what happens when you have a filing responsibility in additional states. And all you had to do was, was pay a marginal amount in compliance, but you needed to be collecting and remitting on behalf of your clients, your customers. If you don't do that, the exposure is severe.
And just to add to two instances, I had a client never filed a local state income tax return. It was brand new news to him on his multi-million-dollar company that he had state income tax filing obligations. And then the additional point with the sales tax is that a lot of companies outgrow their providers, but their providers aren't going to tell them they've been outgrown.
Right.
And so, to your point, like, they're not going to be raising their hand saying you ought to be reassessing Nexus on an annual basis because they don't know how to do it.
Right.
Yeah, happens all
Sorry.
the time. No, good. Other thoughts around either exit planning or mitigating financial risk?
I can chime in on the identifying the financial risk and mitigating. So I think the first step would be for companies or individuals to have a process in place. First, business owners, I think, should understand the business and understand the risk that can impact their business. So maybe if they have a risk assessment process where they can follow and use to identify those risks. So that would be a good start. And in terms of mitigating the risk, I think they have to first, maybe when it comes to financial risk, maybe diversify their portfolios, have a backup plan, and maybe have some controls in place that would help them mitigate the risk.
That's awesome. Thank you. Other comments?
Yeah, and just tack on what William said, really, it's kind of a, we look at it from what could go wrong from a risk, standpoint. And then, if you do kind of have a process to go through that, trying to identify, hey, what are those risks? How severe are they? How likely do they occur? And then also, what can I do to detect them before it becomes a huge problem? We kind of have this preventative thing happening, and they'll, unfortunately, a lot of the accounting controls are detective. After something happens, it'll, we'll find it, but it's too late, especially if it's kind of a fraud occurrence. And yeah, also we talked about the exit planning. That's also a financial risk from, the two certainties. Someone leading that organization isn't going to be there 5, 10, 15 years from now, whatever it is. And then who's going to step in the shoes? So, kind of what is that succession planning? Because, it's kind of the poor example is just like that somebody has to exit immediately. Who's going to do their job? And can anybody do their job? And you don't want to kind of have to exit the ownership group under duress because, the multiple on that is going to be fairly low.
Yeah, for sure. It makes me think about a client. When I did commercial real estate, we'd always have to look at the financials because when we were going to go buy a building, we want to make sure. And I look at this small company, they were going to buy a 10,000 square foot building, but they had $12 million in cash basically on their financials. And I asked them, where did that come from? And they said, oh, that came from all of the deposits that everybody gave. And then I go, what is this account that it's in? I got friendly with the CFO, and he goes, oh, we trade it, we do the currency exchange every night. And we make, 10 to 15% on other people's money every night. So basically they were trading the people's money that was put up for deposits for their trips. So anyway, talk about risk. these guys were nuts. I know you guys see financials every day, but boy, I saw that and I was just shocked. So there's my liability potential risk thing.
Wow.
Yeah, fun stuff. So Michael, so do you have any thoughts on certainly exit planning or the liability side of things?
Yeah, I
Yeah.
guess.
Oh,
Oh,
sorry.
sorry. I don't know which Michael.
Go ahead, Michael. Benino, go
Okay,
ahead.
I'll talk on the liability side. I mean,
Okay.
we've probably got we've got a ton of liability on the road every day. We've got trucks, that I feel like we're always an accident away from using a lot of our insurance. And so I think for us, the biggest thing is, do we have enough insurance coverage, and having a broker that you trust and that you're working with to make sure that you've got the coverages necessary. And then the other thing on my side is really the contracts with our customers to make sure that I'm not exposing myself to more liability than I've got insurance coverage for. So I'll leave it at that. And then on the exit planning, I'm just going to quote my boss that says, "We're not for sale, but we could be bought." So I think of it like my house. I wouldn't sell my house for 10 or 20% more than it's worth, but you tell me double or triple, and I'll have the conversation. So I'll leave that for you guys.
Always got to be ready then. The other Michael, go ahead. Sorry.
Yeah. So as it relates to kind of financial risk, I think this is probably the most important thing for us because, we do help investors find replacement properties in a 1031 exchange. For us, if we help investors and those investments don't perform well, our business doesn't perform well. So I think mitigating that really hinges on best practices in due diligence and making sure that our underwriting is extremely conservative. And then in terms of just general financial risk, I think we really try to plan for the unexpected. We track our deal flow out, a year or more, because that is really kind of, what pays all the bills is that transaction volume. And we're just conservative. We kind of estimate a certain percentage of that closing. And it's probably going to be more than that, but conservative estimates are what we do. And then lastly, do a lot of exit planning. 1031 exchange is a very powerful tool. For exit planning, we see a lot of business sales where they have a real estate component and they're leveraging either a 1031 exchange, maybe lumping in an opportunity zone, although that seems to be waning a little bit. So I would echo the tax attorney on the call saying a lot of planning, you can do a lot to mitigate gains on the sale of a business. So I'll leave you with that.
Thanks, Michael. Other thoughts?
Yeah, I'd like to just jump in regards to the succession planning. I was working on a transaction a few months ago, and I agree with some of the comments here, in terms of, our clients, they usually don't file their state income taxes or their state sales tax returns on a timely basis, or if they ever do so. But what we try to do is, for our clients, we usually run a nexus study every year to see, where their liabilities fall into place. And, we tell them, hey, this is going to be your tax liability for this such and such state, which may be less than what the compliance fee would be to prepare the returns and for you guys to file it. And so ultimately it comes down to the decision of management to decide whether they want to file those returns or not. And then they come into this point where, they decide to sell their business, but then, they have this huge hole in terms of compliance issues. But we usually run the analysis and say, all right, when we tell the potential buyer, hey, this is your potential liability, so you may want to do a purchase price adjustment to account for this, to account for this oversight. So that's basically how we usually do our M&A transactions here.
Alexi, from the audit side, any thoughts?
I think as far as exit planning, I think, and somebody had said it earlier, I can't stress enough the importance of making sure that everything's in order. It seems like financials, oftentimes people look at it as a compliance exercise and they don't want to spend the money or the time to get them right. And that's fine until you need them, and then they tend to be in a crisis. So I would agree with that, making sure that everything's correct, especially from a GAAP perspective. Just because we see a lot of deals get derailed or a lot of transactions happen and then it's not what they thought. And it takes a lot of time and money to fix the GAAP problems, probably more than it would have just to get them right on the front end. I think somebody else has said that as well.
Yeah, great point. I'm going to call on Will, because I know, Will, you were working in private equity, doing a lot of transactions. So what are your thoughts around prepping for an exit?
No, I mean, I agree with what Alexi just mentioned. We've seen this year diligence times are getting longer for companies doing deals. So private equity buyers are spending a lot more time doing diligence, and consequently more deals are falling apart because their issues are arising in diligence that companies could have easily mitigated, whether it's GAAP related or just understanding historical numbers or projections better. Seeing a lot more emphasis on that due diligence effort, and it's creating issues. So private equity guys are retrading deals because of stuff that comes up, and it's usually a deal breaker when that happens.
Yeah, that's terrible. You think you got that double, Michael, right? You got that double sale until they look at the financials and dig into it, and they're like, wait a second, we're going to give you 10%. That's not a fun day. Other thoughts around this? All right. Okay. Well, it looks like we're going to tee you up, Steve, for 20 minutes and then give me some time to close. So Steve's going to talk about a little bit more about Nexus. The goal here is to do maybe 10 minutes, as Steve and I have talked about, and then keep it open for some questions. And then we'll close out the meeting sharply at 1:30. I see a lot of folks here thought it was an hour, so apologize for that. But Steve, it looks like you got a good attentive audience here. None of them are asleep. Okay.
Hey,
So
well, let's try and keep it that way, right? If we can. Forrest had reached out to me last week, and with this being the initial meeting and everything, I'm guessing this is perhaps a litmus test where if you're willing to listen to me for 10 or 15 minutes, then maybe you're serious enough to really buy into this program. Let me ask you, can I go ahead and share my screen? I don't have a PowerPoint, but I just got a little bullet point presentation. And if I can't, it's not a big deal.
No, you're good. You're good. Go ahead. Yeah, Steve knows that we have a no PowerPoint policy here at Highrise, because a lot of people fall asleep during this.
Yeah, this is not going to be bum, bum, bum. Let's see. Is this coming up? Are we good?
Yeah. We got
it. All right. That's all there is. One page. Okay. Forrest reached out to me, and he wanted me to talk about multi-state sales tax nexus. So let's just go ahead. And this is going to be at a high level now. And let me check the time to make sure. I can talk about this all day long, and I won't. Nexus. Nexus is just Nexus. If you're not familiar with that term, it's just a $5 word that means connection. Okay. So the issue that we're talking about here is if you are in state A and you are selling a taxable good or a taxable service, state A obviously can compel you to collect and remit sales tax on those sales to your customers. But what about state B? Can state B require you to? Well, it depends upon if you have a sufficient nexus, if you have a sufficient nexus with state B, that they can compel you to collect and remit sales tax. And the first issue with nexus is physical nexus, and it's pretty straightforward. It's exactly what you would think. Even if you're headquartered in state A, if you've got employees in state B, if you've got inventory, you've got an office building, you've got something like that, that is considered physical nexus. So state B is going to say, okay, you have to file in this additional state as well. Now, this was the way that it was since time began until 2018. In 2018, we had the Wayfair decision. You are perhaps familiar with Wayfair. They send out their catalogs all across state lines, and their revenues are fairly substantial. But they did not otherwise have a physical presence in these states. By the way, interesting issue, a little bit of trivia, 5-4 Supreme Court decision. You can thank RBG. RBG, a notorious, I'm not sure if that's the proper term, but historically a strong liberal justice. She sided with the conservatives. And if that hadn't happened, we would not have this law. 2018, the Wayfair decision comes out, and the Supreme Court says, you know what? From now on, states can require remote sellers, and the definition of a remote seller is just somebody that is in state A selling into state B. They can require, that state can require them to collect and remit sales tax on their remote sales. You got two factors here. You got a dollar threshold and a transaction threshold. Okay, and these are measured annually. And I like when I provide this, I like to let you know up front how wonky this rule can be, because the thresholds, dollar and transactions, they're measured annually. Well, before we even get into them, well, what's a year? And with 50 states, 45 states with a sales tax law, plus DC, plus Puerto Rico, with 50 states, with all those states, you've got a lot of different options. So what is it? What is a year? Well, we typically think about a year as being a calendar year, right? 1/1 to 12/31. Well, some states say that that's what a year is. Some states say trailing 12 months. Some states say trailing 4 quarters. So you've got to look at it. If you've got a state that has a $100,000 threshold and you sell $80,000 in year 1 and $80,000 in year 2, but those two sales are in December and January, all of a sudden you've actually gone over the threshold. Those dollar thresholds are typically between $100,000 and $150,000. Smaller states, lower thresholds. Bigger states, higher thresholds. You got to look at what is a sale. And I'm not going to go into a deep dive on these, but there's a distinction between total sales versus, and that includes wholesale sales, versus sales of tangible personal property. That's what in our industry, TPP is tangible personal property, versus taxable sales. Some states say, if you're selling wholesale, I really don't care, because that's a purchase for resale. That is the most basic fundamental exemption in sales tax. Is if I'm selling it to Walmart and then Walmart is selling to the end users, I don't have to worry about my sales for Walmart. Well, some states say all we look at is your taxable. Some states say everything. And the last item there is retail sales. And you would think, well, that would pretty much cover everybody, right? Because we've already talked about wholesale sales. We've talked about taxable sales. I tell you what, I've got a client. All they do is they sell to the federal government. So let's look at that. Is that a wholesale sale? No, it's not a wholesale sale, because the federal government is the last purchaser. Is it a taxable sale? No, because the federal government doesn't pay sales tax, but it is a retail sale. So I have a client that's filing in about 15 states. Every return they have is a zero tax due, but they have a legal requirement to file. Okay. The second factor here is transactions. South Dakota was the first state they took the Wayfair decision, the Wayfair case, all the way to the Supreme Court. They set a standard of 250 transactions. Most states have followed that, but I will also let you know that that is something that's starting to go away. And I mentioned that in the next bullet point there of nuances. I tell you, I've got one client that they sell tumblers. And those are not real high ticket items, but it's easy for them to sell 3 or 4 or 500 into a state in a year. Well, their sales dollar amount aren't that high, but they have a responsibility to file. And states are finally kind of figuring out, you know what, we really don't need to have these guys filing in these states if they have a requirement to remit $500 or $600 a year. It's just not really worth the benefit of them having to file these returns. I'll also mention there are or states and states. This is going to make sense. You got two factors, dollar and transactions. Most states are or states. In other words, if you meet either the dollar threshold or the transaction threshold, you have a requirement to collect and remit sales tax. There are a handful of states that are and states, which in my opinion doesn't make a lot of sense. When have you ever seen a Congress, a legislature not make sense? Well, it doesn't really make sense to me because, and this is a true example. New York is an and state. They have, I believe it's 250 transactions and $500,000. Now they're a large state, so they have a high dollar threshold, but they require you not only to have $500,000 in annual sales, you also have to have, it's an and state, 250 transactions. Well, you know, what happens if you're Boeing and you are selling, you know, $5 million airplanes into the state of New York? Well, until you sell 500 a year, you would not have a responsibility to collect and remit sales tax on those remote sales. Really didn't make any sense to me to limit that, but you know what? The New York State Legislature did not run that past me, so you can't blame me for that law. I'll mention a couple of complexities and a couple of stories here. Rentals. You know, we talked about physical nexus, and when you think about physical nexus, generally what you're thinking about is businesses talk about, you know, the employees, inventory, do I have an office building or something like that? And I had an issue come up fairly recently with a client where they said, my dollar amount of sales are very, very low. I'm transferring them into these additional states. And I told him, you know, I don't think you have too much of an issue. Did you not have over $100,000 in sales? No, I don't, so I have to worry about that. And I said, what are you selling? And they said, well, these really high dollar pieces of equipment. And I said, if you're selling high dollar pieces of equipment, how come your sales are so low? Well, we're not really selling them, we're renting them. Well, if you're renting tangible personal property, what is that? That's your inventory. If you do that across state lines, you are literally employing your tangible personal property in other states. That first dollar of rental revenue is going to be subject to sales tax. I got another story about, I've got somebody that is selling across state lines and they have a legal responsibility to file in about 20 states. And we went through a nexus study with them and we went over all these issues. And then I go out to their website and it says, for more information, here's our sales rep in these 12 states. And here's our sales rep in these 7 states. And I said, wait a minute, you never mentioned that, you know, you had sales reps. Oh yeah. Well, what can they do? Well, they go out there and they pound the pavement and they sell our wares and they can take orders for us. And I said, well, that's physical nexus. And they said, no, they're not our employees. They're not W-2. And I had to explain to them, even though they're not W-2 employees, they still have an agency relationship. I'll go ahead and close out by saying, well, what's next? Let's say that you have acquired a business or you're looking at acquiring a business and they have this responsibility in 20 or 30 states. Essentially, you've got 2 different options. Well, I'll leave off the table, do nothing, because that's never a good option when you're dealing with the government. One is voluntary disclosure agreements. That's VDAs. And that's where you go back and you say, hey, listen, it's a mea culpa. It is this is what we owe. We know that we've messed up. We know that we owe you X amount of money for the last 3 or 4 years that we have been active in your state, but not collecting or remitting sales tax. Nice thing about the VDA is it typically removes penalties, sometimes removes interest, and they can only go back as far as the statute of limitations. Otherwise, they can go back since time began, but they tend to be expensive. And then the last item there is registrations. And registrations that's what I call the go forward and sin no more. In other words, you're not doing anything going back and that exposure is still out there. But when you get registered, you say, going forward, on a go forward basis, we're going to go ahead and collect and remit sales tax and frankly, cross our fingers. And hopefully my time was about right.
All right, so let's open it up for questions for Steve.
I have one question and one comment. On the VDA point in an M&A transaction, your typical agreement precludes the buyer from doing a VDA post-acquisition that impacts the pre-acquisition tax years. So you're
Does it?
kind of,
You say, does it normally?
it does.
Yeah, I was about to say, yeah, that's, well, any tax attorney, they're gonna tell you what, a couple of your favorite words are successor liability, right?
Yeah, no, I mean, the sales tax, even in an asset transaction, sales
Yeah.
tax liability follows assets, which is not typical in most other transactions. There's provisions that could be implicated, but the VDA route is limited in your M&A situation because you're essentially sitting on your hands for the statute of limitation periods and then filing a VDA going back to the acquisition, the first year after acquisition.
Yeah.
And that's ugly.
Yeah.
I had a question as it pertains to online services. I have a client that is essentially like a VRBO for a foreign country rental properties, but his primary client base is here. I'm certain he's not collecting sales tax anywhere. And I have this strong suspicion he might have sales tax obligations depending on the footprint of his customer base, but
I'm sorry, did you say that the properties are international?
Yeah.
Okay.
But the business is here, the clients are here.
Right. Okay. Yeah, I don't know that he would have a liability here stateside, anything domestic, because the service is provided outside of the U.S. You do bring up another interesting nuance here is we tend to paint with a broad brush stroke, but these rentals, these are not subject to sales tax. They are subject in general to under hotel occupancy tax, or there are some other terms depending upon the state, but literally it is a different statute. It's a different kind of tax.
And that for our logistics colleague who may or may not still be here, there's a similar tax that applies for them as well when they're going across state line, I think. Mm-hmm. Or have you encountered that?
Well, generally, most states are not going to impose a tax on a basic service like transportation services. There are some exceptions. New Mexico has a gross receipts tax. Hawaii has a gross receipts tax. Pennsylvania and West Virginia potentially. But generally, if we're just talking about moving something from point A to point B, that's going to be a non-taxable service. But you bring it, how would you address it if somebody delivered something from El Paso to Clovis, New Mexico? That involves two states, and I would say I would have to leverage that down to one of my managers to get a good answer on that.
Nice. Other questions for Steve?
I have a question. Yeah, hey Steve, we do a lot of referral relationships. Our platform, we market other technology platforms and receive a referral fee. Would we have any tax obligations, in that referral fee?
I certainly wouldn't think so, because we're talking about you do not own the technology, correct? So it's not like it's an intangible, but commissions, referral fees, same issue. There are a couple of gross receipts states that might consider that to be taxable. New Mexico and Hawaii are the first two that come to mind, but for the most part, pretty much every state is going to say a sale of tangible personal property, something you can pick up and move, is going to be subject to sales tax. Services are much more limited, and generally it's the ones you think about. It's cable television. It's telecommunications. Those are services that are generally taxable across state lines.
Got it. Thank you. Appreciate it.
It could be impacted your state income tax profile, though. You should have a CPA.
Income tax, sure.
Yeah, I was going to ask Steve how often, because I've seen where clients said, well, I just filed the state safe to be sorry, and then they get a notice from the income tax board of that state going, how come you didn't file income taxes here? And I think the government departments are getting a lot better talking to each other. So, yeah, it's kind of, are you really setting yourself up for, now I got to file not only sales tax, now I got an income tax filing obligation.
Yeah, I don't think they're getting worse at that. Let's put it that way. It used to be that the left hand didn't know what the right hand was doing, in my opinion. But I do think I think that you're right, Patrick, that's coming into play more and more. Now, still, you got Public Law 89-272 that provides protection for interstate commerce, but it only provides protection for income tax, which is why the nexus requirement is so much more challenging for income tax than for sales tax, because 89-272 doesn't apply to sales tax. So those are still split, but let's put it this way: they may be split, but they're getting closer.
Wayfair impacted it. So.
Yeah.
Steve, I have a question, and just for full disclosure, Steve and I, our firms have done business together before, but Steve, I heard you describe there's the do nothing, there's the VDA, and there's the voluntary registration. And you and I have encountered more than one client together that the CEO is of the mindset, well, I'm just going to do nothing and bury my head in the sand. How do you get past that situation when you're dealing with a client and telling them, don't wait until they come knocking on your door?
Yeah. Well, I think you were on earlier when I said that when I talked about how the worst thing in the world is not paying tax, the worst thing in the world is paying someone else's tax. And it is in a pretty simple, I think probably a pretty basic Excel spreadsheet. You can say, okay, let's say that you have X number of revenues in, let's say, a half a dozen states. And this is what it's going to cost you from a compliance perspective. Okay, now let's compare that to if you have the same revenues in the same number of states. Let's see what it would cost you if you did not, all of a sudden those states knocked on your door and said, hey, I audited ABC company over here, and I know that you're XYZ, but the invoices that I looked at ABC were from you and they didn't have sales tax. So now I'm looking at XYZ. And by the way, that's where many sales tax leads are generated, is from, I'm going to audit these guys, and what I see over here makes me look over there. That can open up a whole can of worms. And when they look at the compliance fees and compare it to the potential exposure, it's a little mind-boggling why I think anybody would not do that. And another thing and I don't twist arms. David will tell you, I'm not an arm twister, but I will also say any business that is interested in an exit strategy, I'm going to tell you, I think that pretty much any buyer, that's one of the first things that they're going to look at is, have you been compliant on your sales tax? And not only is there a potential, a price adjustment there, but in addition to that, if I'm a buyer, if I'm buying this company and they should have been filing sales tax in 20 states over the last 6 years, I've got to wonder if they're messing up over here. Where else are they messing up? What other things have slipped through the cracks?
Right. Awesome. Time for one quick question. Last question. Go ahead, Patrick.
I was going to say, yeah, no, that comes up in every M&A transaction I've been involved with. And to your point, if they're not doing the sales tax, payroll tax is probably an issue with independent contractors. And then you start getting into local taxes, that it just starts unspinning the web. And the more the private equity guys start asking questions and the more expensive the targets gets, you kind of know where that goes. So.
How many more rocks can I look under?
Yep. And then that 3-month due diligence turns into 6 months and then 9 months and the deal still doesn't get done.
Right.
Wow. All right. Well, thanks everybody for being here. This was fantastic. I think we'll attest it was much better than the operational group where it was just a couple of us. So great dialogue. It's only going to get better. I have posted in the chat, and I'll certainly follow up with you guys. We've decided to do an add-on program for this for our Highrise members. and we're making it only $700 to add a second group. And then for the brand new people to Highrise, if they don't have an existing group, they can join on a quarterly basis for $450 a quarter. And we're doing that specifically because we want to make sure this group shines. There's great information happening. You guys are amazing. The topics will continue to refine as we go forward and we get a solid group of folks. And our goal, we're working on a September potential launch where we're going to give our Highrise members and our new members 2 groups for one price is the way we're going to do it. We're going to increase the price a little bit, but they will get their local group as well as they can have a focus group on top of that. So those are some exciting things we're working with because we really see the power of this knowledge transfer that we just saw today. And we think it's just great. And sometimes it needs to be a national group to make it really flourish. So Steve, thank you so much for being here and threatening us, well, no, making us more aware of all of our client steel tax issues and also our clients. So again, thanks everybody for being here. I'll hang out for a little bit if anybody wants to stay and ask any questions, but I really appreciate you guys being here and we'll see you hopefully at the next meeting.
Thanks so much. Take care.
Thank you.